Welcome to our podcast channel. I am your host. Today, we're diving deep into the world of investments, specifically focusing on real estate investment strategies and how they tie into your life stage and financial goals. We are also going to touch upon the subject of dividends and options for effective loans when considering real estate investments. Seasoned investor or new in the game, there is something here for everyone. Let's get started. Investing in real estate can be rewarding to grow your money over time, but it also involves some risks. How much risk are you willing to take with your money? And how does that affect your investment strategy? These are important questions to ask yourself before investing, as they can help you choose the right investments for your goals and preferences. Here, we will explain investment risk tolerance, how to determine yours, and why it matters for your investment strategy. First, let's unpack the concept of investment risk tolerance. What is it? Simply put, investment risk tolerance is a measure of how comfortable you are with the possibility of losing money on your investments. It reflects your attitude towards the uncertainties that come with investing. There are generally two types of investors. One is risk-averse investors. These individuals prefer safety and stability in their portfolios. They might choose investments like bonds or cash equivalents that may have lower returns but provide more security. Another one is risk-tolerant investors. These investors are willing to accept fluctuations and volatility in hopes of achieving higher returns. They often invest in stocks, real estate, or other assets that can yield significant profits, albeit with increased risk. Importantly, risk tolerance is not static. Can change over time based on personal circumstances, financial goals, and investment experiences. For example, an investor nearing retirement may become more risk-averse, while a younger investor who has had success with a high-risk investment may feel emboldened to take on more risk. As you consider your investment strategy, it's crucial to assess your own risk tolerance. Reflect on how much risk you're comfortable with and how various life events like a new job, marriage, or children might change this tolerance over time. Now let's talk about financing your real estate investments. Understanding the landscape of real estate investment loans is crucial before diving into property ownership. Now let's understand what are real estate investment loans. Real estate investment loans are distinct from traditional mortgages, intended for purchasing properties meant to generate income or appreciation rather than being lived in. There are several types of loans, each catering to different investor needs. Let's understand each one of them one by one. First one is hard money loans. These are short-term asset-based loans primarily used by investors who need quick cash. The primary determinant for approval is the value of the property, making them accessible even for those with less than stellar credit scores. While they can be secured quickly, they often come with higher interest rates. This makes them ideal for short-term projects such as flipping houses. The second one is private money loans. This type of financing comes from private individuals or investors rather than institutional lenders. The terms and rates vary significantly, often negotiated between the involved parties. Private loans can be more flexible, but do carry risks depending on the lender's requirements. The third one is fix and flip loans, designed specifically for investors who purchase properties to renovate and sell quickly. These loans often come with short repayment periods and higher interest rates due to the quick turnaround expectation. This strategy can be profitable for experienced investors who know how to manage renovations efficiently. And last one is home equity loans. For homeowners looking to invest in additional properties, leveraging the equity built in their current home can be a smart move. These loans allow homeowners to borrow against the value of their home, providing capital for a new investment property, often at lower interest rates than traditional investment loans. When pursuing real estate investment loans, it's vital to conduct thorough market research. Understand current real estate trends and calculate your investment's potential profitability. Looking at previous ROI or return on investment will help set realistic expectations. Next, let's explore the concept of dividends, which can significantly enhance your investment portfolio. Dividends are payments made by companies to their shareholders, usually derived from profits. They are essentially a way companies share their successes with investors. What you need to know about dividends, let's understand each one of them. 1. Dividend yield. This is the annual dividend payment divided by the stock price. A higher yield can indicate a more lucrative investment, but it's essential to assess whether the company can sustain its dividend payments, especially during economic downturns. 2. Types of dividends. There are cash dividends, where you receive cash payments directly, and stock dividends, where additional shares are issued. Understanding these options helps in tailoring your investment income strategy. 3. Tax implications. In the UK, as of the 2023-24 tax year, investors have a £2,000 tax-free dividend allowance. Beyond this, dividends are taxed based on your income tax bracket. Basic rate taxpayers are charged 8.75% on dividends exceeding the allowance. Higher rate taxpayers pay 33.75%. Additional rate taxpayers pay 39.35%. Being aware of these tax implications allows you to maximize the efficiency of your investments. Furthermore, using tax-efficient accounts such as ISAs can keep your dividend earnings tax-free, enhancing your overall returns. Now let's look at how your investment approach should change based on your age and life stages. This concept is often referred to as life stage investing. Early career, 20s to early 30s. In this stage, many face student loans and other debts. However, this is also the optimal time to start investing. Younger investors can afford to take more risks since they have more time to recover from market fluctuations. Consider focusing on growth investments like stocks or ETFs that can provide long-term returns. Next one is career development, mid-30s to 50s. This period often signifies peak earnings, making it an ideal time to significantly ramp up savings and investments. Balancing your spending with aggressive saving for retirement is vital. Many in this phase also face additional responsibilities, such as children's education or mortgages, which can impact financial decision-making. Now, next stage is pre-retirement, late 50s to 60s. As you approach retirement, your investment strategy should shift from growth to income generation and capital preservation. Diversifying your investments to include safer assets like bonds or dividend-paying stocks can help protect your capital while ensuring a steady income stream. Next one is retirement, 65 and beyond. At this stage, your focus should be on ensuring your savings last throughout your retirement. You may want to engage in systematic withdrawals or consider annuities for guaranteed income. It's crucial to adapt your portfolio to manage potential healthcare costs and adjust for inflation. No matter your stage, regularly revisiting and adjusting your investment strategy is essential for long-term financial health. In conclusion, understanding real estate investment loans, optimizing your dividend strategy while considering tax implications, and tailoring your investments based on your life stage are all key factors for financial success. By being informed and proactive about your investment choices, you set yourself up for a robust financial future. Thank you for tuning into our podcast. We hope you found this discussion helpful. Be sure to share your thoughts or questions and join us next time as we continue to explore investment strategies that align with your financial goals. Don't forget to subscribe and spread the word. Welcome to our podcast, where we explore the dynamic world of real estate investment. Today, we'll discuss how to conduct effective market research, identify investment opportunities, and the strategic advantages of using property auctions. Let's dive right in. Market research is a necessary tool for any business, and especially in real estate. It helps you identify the opportunities and understand the needs of your target market. By gathering insights on your audience, competitors, and market trends, you will be able to make well-informed decisions that would drive success. Knowing consumer preferences and behaviors may help tailor products and services, enhance marketing strategies, and ultimately improve customer satisfaction. The question remains, how do we conduct effective market research? Here are some actionable tips for conducting effective market research. Define your objectives. Start by pinpointing what you aim to achieve with your research, whether it's finding new opportunities or refining existing offerings. Choose your methods. Decide on methodologies that fit your objectives, whether it's surveys, interviews, or focus groups. Collect data systematically. Gather information through reliable channels, whether it's online surveys or real estate reports. Analyze the data. Look for patterns and trends that may reveal opportunities. Your analysis should be objective and thorough. Draw conclusions. Use your analysis to make informed decisions that will guide your investment strategy. Now let's talk about identifying real estate investment opportunities in the UK. First, define your criteria. Establish what you want in an investment: budget, risk tolerance, and expected returns. This clarity helps narrow your search. Then, research the market. Stay updated on industry trends and regional demands through financial news, reports, and real estate blogs. And evaluate performance. Utilize metrics such as return on investment, ROI, and cash flow analysis to evaluate possible investments. Historical performance may provide insight into future potential. Thinking about investing in a vacation rental property to rent it out on Airbnb? Today's episode is packed full of insights on how to prudently evaluate rental income and capital appreciation. It can be a lucrative business decision, but it's crucial to understand how to evaluate a rental property and estimate the potential of your vacation rental investment. After all, buying an Airbnb property is a significant financial decision, and you need to be wise to be successful. It is a wonderful investment, but let's face it, the stakes are high. A piece of property purchased for Airbnb is not some simple transaction. It's a financially significant commitment. So what do you do to make sure this is a good decision? First, inspect any rental property you're considering, just as you would conduct market research before investing in a business. You want to look at the overall demand in the area when evaluating a vacation rental. Is it year-round traffic or a seasonal hotspot? Knowing what's going on with your location is very important. Let's dive into some critical metrics that can help you assess a rental property's performance effectively. First is occupancy rate. This is the occupancy rate, which is essentially a measure of potential profitability. It's calculated by dividing the number of nights that a property is booked into the number of nights available. The higher the rate, the more in demand the property is likely to be. Lower occupancy rate might indicate problems with location or marketing. Second is cash flow. Cash flow is basically how much real profit you get after taking care of all the expenses incurred for a particular month in your rental. Just take away all operating costs, such as property taxes, insurance, maintenance, and utilities, from your income. And if that cash flow happens to be positive, congratulations, you're doing good. Next one is capitalization rate, cap rate. Cap rate can give insight into the investment return that is not subject to financing. To get it, divide your annual net operating income by the purchase price of the property. A good cap rate ranges between 8% and 12%. This means that is a pretty good investment. Another one is cash on cash return. This measure allows you to estimate your profits based only on the cash you invested. You can compare profitability across different properties by dividing your annual cash flow by the total cash invested in the property. Let's now transition to discussing how to evaluate your return on investment, or ROI, which is critical in determining profitability. For cash purchases, it's pretty easy to calculate ROI. Divide net operating income by the purchase price. However, if you pay using a mortgage, you need to consider the down payment and other mortgage payments. That increases the complexity of the equation. Now that we have that covered, let's move on and discuss investment in the UK property market, which happens to be an increasingly hot region for rental investments. The UK has shown consistent growth and stability, particularly in the Northwest, which boasts high rental demand and competitive yields. If you're considering this market, immerse yourself in local property trends and legal regulations. This due diligence is crucial. Key factors to consider include researching rental demand. Analyzing trends, vacancy rates, and the job market will shape your investment strategy. Financing options. Explore various mortgage options with favorable terms to maximize your returns. Stay abreast of tax regulations impacting landlords to make informed decisions. And property condition. Always conduct thorough inspections to avoid unexpected costs down the line. And of course, no discussion of property value is complete without location. Said to be the cornerstone of value, it is worth investigating planned infrastructure improvements and market conditions to understand how a property will appreciate over time. Ultimately, whatever you decide, remember, investing in real estate is a long game. Focus not only on the present, but also on future growth potential, and keep a diversified portfolio to mitigate risks. Before we close, let's make sure you're aware of the legal matters involved in being a landlord, such as zoning and safety. It's best to consult professionals when dealing with these complexities. This makes your investment much smoother. Now let's explore the key factors that influence property demand and supply in the UK. Whether you are a current homeowner, a prospective buyer, or an investor, this information is essential for making informed decisions in the ever-changing real estate market. Let's jump right in. Now, first up is the economic environment. The state of the UK economy plays a significant role in shaping the housing market. When we witness strong economic growth characterized by low unemployment and high GDP growth, we often see an increase in property demand. Simply put, when people are earning more and feeling secure, they are more likely to invest in real estate. Conversely, during economic downturns, fewer prospective buyers can enter the market due to financial constraints, leading to reduced demand and declining property prices. We have to talk about interest rates. When the Bank of England lowers rates, borrowing becomes cheaper. This encourages buyers to enter the market, often pushing property prices higher. Next, let's consider property characteristics. Numerous factors directly linked to a property can influence its value, such as curb appeal, size, age, condition, and amenities. Recent renovations often enhance a property's value, while dated decor can do the opposite. It's interesting to note that unique or desirable features, like period charm or extra bedrooms, can command premium prices. So if you're planning to sell, investing in modern upgrades might just pay off. Moving on to the principle of supply and demand, an age-old economic concept that holds strong in real estate. When there's a shortage of properties available relative to the number of buyers, we typically see bidding wars and escalating prices. This is especially true in hotspots where housing development lags behind population growth. On the flip side, when supply exceeds demand, buyers have more negotiating power, potentially driving prices down. It's all about balance. Now let's talk about investors. Real estate investors are major players in the UK market. When they see potential for attractive returns, they're more likely to buy up properties. Areas that feature affordable houses with potential for appreciation attract these kinds of buyers. Their presence can inflate local prices due to their competitive bids. Speaking of affordability, it's crucial to consider mortgage availability. During times of economic uncertainty, lenders often tighten credit conditions. This means fewer buyers can secure financing, leading to downward pressure on prices. Conversely, a relaxed lending environment with lower deposit requirements and competitive interest rates can lead to increased buyer interest and stronger sales prices. Another important factor is residential rents. If rents rise sharply in an area, buying property becomes more attractive, potentially increasing demand. On the other hand, stagnant or declining rents can discourage real estate investment, causing prices to stall or even decline. Next, we have new construction volumes. If housing development keeps pace with population growth, we can expect market stability. However, an oversupply can create buyer leverage and soften prices. Monitoring new construction is key to anticipating market shifts. Of course, the property market isn't solely driven by numbers. Emotions and market sentiment play vital roles too. When buyers are optimistic, they enter the market eagerly, often driving prices up. But if fear and uncertainty set in, it can lead to price decreases. Being aware of emotional market dynamics helps sellers and buyers navigate their pricing strategies wisely. Lastly, let's discuss unforeseeable events. Financial crises, regulatory shifts, and natural disasters, these events can disrupt market stability in unpredictable ways. While they tend to have short-term impacts, reliance on underlying economic drivers is essential for weathering these shocks and maintaining an effective pricing strategy. Of course, the property market isn't solely driven by numbers. Emotions and market sentiment play vital roles too. When buyers are optimistic, they enter the market eagerly, often driving prices up. But if fear and uncertainty set in, it can lead to price decreases. Being aware of emotional market dynamics helps sellers and buyers navigate their pricing strategies wisely. Lastly, let's discuss unforeseeable events. Financial crises, regulatory shifts, and natural disasters, these events can disrupt market stability in unpredictable ways. While they tend to have short-term impacts, reliance on underlying economic drivers is essential for weathering these shocks and maintaining an effective pricing strategy. To wrap up today's episode, it's essential to understand the myriad of factors influencing the UK property market, from economic conditions and property characteristics to investor activity and construction volumes. Considering these elements, you can make more informed decisions whether you're buying, selling, or investing. Thanks for joining us today. If you found this episode helpful, don't forget to subscribe. Share it with anyone you know looking to understand the UK property market better. Till next time, stay informed and keep investing wisely.